In this chapter, we're going to talk about accounting for corporations, or at least that's how it's titled. Really, what we're going to be talking about is the equity section of the balance sheet. And while we're at it, we're going to introduce to you the corporate form of organization. It is the most appropriate time to do it because the equity section of the balance sheet is really where you account for the fact that a business is structured as a corporation. So when we're talking about a corporation, there's a few things that we need to understand. First off, it's an entity created by law. There's a regulatory agency in each state. In Virginia, it's the State Corporation Commission, in which people will go to and say, I would like to create a business and I want it to be a corporation. Will you create this entity? And the State Corporation Commission has the authority to create this particular entity. Its existence, the corporation's existence, is separate from its ownership. And that's a really important fact when we start talking about liability. A corporation can be one that is privately held, meaning that the stock ownership is held by individuals and they don't publish that ownership anywhere. But a publicly held company is one in which almost anybody can go and buy and sell stock using stock exchanges like the New York Stock Exchange. Pick up the Wall Street Journal and you'll find a bunch of publicly held companies there without a doubt. Has rights and privileges. It means that the organization itself can sue, it can be sued, it can be held accountable in a court of law. Here's some characteristics. Advantages. One, that separate legal entity, that is certainly an advantage. Limited liability of stockholders is the biggest advantage that we deal with in a corporation, and that means that the stockholders only can lose their initial investment in the corporation, or actually any investment that it makes even after its initial investment stand to be lost, but the stockholders can't be held liable for actions of the corporation. Transferable ownership rights, meaning that if you buy share of a corporation, you can transfer that or sell that to someone else. A corporation also has continuous life, unlike that of the sole proprietorship, where if the owner dies, the organization dies. In a corporation, if owners die, the corporation just keeps going because it has that separate legal existence. Lack of mutual agency for stockholders means that the actions of the corporation really do not become the actions of the stockholder. And the ease of capital accumulation. It's not that it's necessarily easy, but there are several other ways that we can acquire capital, that is, get money to run our organization outside of just lending. What about disadvantages? Well, the first one's going to be governmental regulation. The first thing I'll tell you is that a corporation has no moral compass, and they need to be regulated to a certain extent in order to keep them on track with our society. The second, which is probably the one that we most hear about, is corporate taxation. Corporate tax rates are among the highest in the United States. We have obviously a recent change here in 2018 with the Tax Cuts and Jobs Act, in which the corporate tax rate was changed from a progressive tax rate to one flat tax of 21%. So now all corporate income is going to be taxed at 21%. So while that maybe doesn't sound terrible, by the way, it used to be averaged 35%. So it's better. But the problem is there's still double taxation with corporations. And you might say, well, isn't that unconstitutional? You're absolutely right. It's unconstitutional, but Congress found a way around that. So what happens is the corporation gets taxed once on its profits. And then when those profits are distributed to stockholders, the stockholders are also taxed on it. And that means the same money gets taxed twice. It's going to get taxed 21% at the corporate level, and then when those profits are distributed to stockholders, it's going to be taxed at approximately an additional 20%. So about 41% tax is what you're going to see with corporations, with a regular corporation. What about corporate organization and management? Corporate governance is the system at which companies are directed and controlled, and you'll see kind of what happens here. Stockholders on the top, employees go to the bottom. Let's kind of blow that up a little bit. The stockholders usually meet once a year, and they have the ultimate control over the organization because they elect a board of directors. The board of directors has the overall responsibility for managing the company in hiring its officers, the president, the secretary, vice presidents, the treasurer, things like that. So the board of directors hire those people, or at least appoint those people who are usually on the payroll for the organization. And it's those folks, the president down, that actually run the day-to-day operations. What about stockholders? What kind of rights do they have? Well, first, stockholders get to vote at meetings. Remember, they're the ones ultimately in control because they elect the board of directors. They're the ones voting on certain policies. Nothing really too operational, though. Stockholders have the right to sell stock and the right to purchase additional shares of stock. If dividends are going to be declared, again, dividends are the distribution of profits to the stockholders. If dividends are going to be declared, the stockholders have a right to receive them. And stockholders share equally in any assets that remain after a liquidation. So if the organization is going to go out of business, they're going to turn all of their assets into cash, pay off all of their debt, then whatever is left over is split between the stockholders in equal share. First thing I'm going to tell you about this slide is that if you ever run across a stock certificate that looks kind of like this, whether it's the Green Bay Packers or anybody else, you should try to keep it and frame it. At least turn it over into some type of digital transaction first and then frame it, because these things are going away. And everybody I seem to talk to in the financial market say, oh, if you find an old stock share that's worthless, you should put it in a frame and hang it on the wall, because one day just the certificates themselves, because they've gone out of existence, are going to be worth some money. So if you find one, make sure that you've gotten the value for it and then try to hold on to it and frame it. I will tell you that if it does have value, most likely when you turn it over to a brokerage and try to turn it back into a digital share of stock, they're going to actually want it. But if there's a way around that, I would try to find a way around that. Each unit of ownership in a corporation is called a share of stock, and this serves as proof that a stockholder has purchased shares. And I say, why are these things going away? Because we don't live in a paper society anymore. Paper's going away, and really you can buy and sell stock digitally all day long and never ever see a piece of paper. But it is a legal negotiable instrument. You have the right to transfer this. If you looked at the back of the stock certificate, it has a place where you can endorse it and make it payable to someone else, but it represents that one share of ownership of a particular organization. So how do we deal with this in accounting? First thing I'll tell you is that on the balance sheet, common stock has got to be explicitly stated as you see it here. We just can't call it common stock, but we also have to say what its par value is, we'll talk about in a second, how many shares are authorized, and how many are actually out there. In this case, the organization is authorized to sell 250 million shares of stock, and thus far, it's only actually sold 92,556,295 shares, but it has to be explicitly stated on the balance sheet. Notice that par value of 1 penny. Well, the 1 penny times the 92.556 million shares is what equals the value of 925,563. But what does that really mean? What is that par value? It really is just an arbitrary amount assigned to each share of stock when it's authorized. Its primary purpose is to make our life easier when it comes to dealing with the accounting for this stock. It's made to make our life easier, because if you can imagine what happens, think about Apple stock. What was the price of Apple stock at 9 o'clock this morning? Okay, well, I don't know, but I can guarantee this. It was different at 9:01, and it was different at 9:02. It was different at 9:15 and 9:30 and 10 o'clock. It's been different almost every minute of every day. Can you imagine having to track that from an accounting perspective, right? I sold this share of stock for $114.72, but I sold this one for $115.32. Oh, wait, I sold that one for $118.23. You can't do that, right? When it comes to trying to keep the books, you would go mad trying to figure out what price you sold every share of stock for over millions of shares. So we assign it this par value to make the accounting side of things just a little bit easier. It has absolutely nothing to do with the market value of the stock. What happens with this no par value stock? What are these classes about? No par value stock is stock that has no assigned value per share by its corporate charter. Well, why would we do that? It has the advantage in that it can be issued at any price without the possibility of any minimum legal capital deficiency, and that means that it cannot be restricted, and we have a slide on that almost at the very end. But no par value stock basically cannot be restricted to any kind of minimum legal capital. We've already talked about par value. That's the piece that we just looked at. It's one that has it on the face of it. Stated value stock is basically no par stock, but it's one in which we have assigned some stated value per share. So we've given it a value, but it truly is no par value stock. So they really are one and the same, except that in stated value, we're going to assign some value in order to make the accounting a little bit easier. All right, so let's talk about common stock. Let's use an example. June 5th, Dillon Snowboards, Inc. We issued 30,000 shares of $10 par value stock for $12 per share. How do we account for it? The first part's easy. I know I'm going to get money. This is one of the ways that we as a corporation acquire capital. So I'm going to sell 30,000 shares of my stock. Now, I've given it this par value. It has a face par value of $10 to make the accounting easy, and you'll see that the market price is different. I sell it for $12. So how much cash do I get? I'm getting $12 a share. At 30,000 shares, that's $360,000. That's a simple transaction. But now, what do we do with the par value? Well, because we do par value, it says that we have to put it on our books at that par value. So I'm putting this 30,000 shares on the books at a value of $300,000. That's the 30,000 times $10 par value. Well, what do I do with the extra 60,000? Because I definitely got another 60,000. And this is why it makes it easier. Whatever the difference is between what you received and the par or stated value of the stock goes into this plug account called paid in capital in excess of par. So what would happen if it were $13 per share? This would have still been $300,000, and this would have represented the extra 3. What if it had been $9 per share? This would have represented the $10 value, and then we would have had a debit to that paid in capital account. See what's happening? It makes it much easier because I just always plug the difference and keep my common stock going on at par value. What does it look like in the stockholders' equity section? Here it is. Common stock, $10 par value. This one says 50 are authorized, 30 have been issued. Okay, there's the 300,000. Then I put in my paid in capital in excess, whatever it may be. And of course, we all know that the equity section of the balance sheet will also include retained earnings. It's just that simple. This is just presentation. Can we issue stock for non-cash assets? You bet we can. A lot of organizations start this way. Somebody has a great idea. I want to start a business. I'm going to make it a corporation. I want my share of the stock because I'm the owner. I have to have my stock. So how do I exchange for that stock? If I don't have the money, what am I going to exchange for that stock? Well, I do own a piece of land that the company can use. Matter of fact, the company needs it. So I transfer the land into the corporation. I go down to the courthouse, sign a deed transfer over, and I transfer that land over to the company's name or the corporation's name, and I had it appraised. It was valued at $105,000. Okay, well, what did the company get? The company got land appraised at $105,000. What did we exchange it for? We exchanged it for 4,000 shares of $20 par value stock. I know what to do with that. I put it on the books. 4,000 at $20 is $80,000. But because this was 105, I have a $25,000 credit difference. It goes into the paid in capital and excess account. And I have equity in the corporation now. So what are dividends? We've talked about dividends before. This isn't anything new, but let's go ahead and explain it a little bit further. This says not just dividends. This slide says cash dividends. And the decision to pay cash dividends rests with the board of directors. It involves more than evaluating the amounts of retained earnings in cash. The directors might decide to keep the cash to invest in the corporation's growth. Maybe they won't give out a dividend because they need to grow the company. Maybe they need cash to meet emergency needs, or maybe they need to take advantage of unexpected opportunities. So they can or cannot. It is their decision as to whether they want to pay a cash dividend. Some might pay cash dividends to stockholders at regular dates just by default. And people who are going to invest in the company will know that ahead of time. This stock normally pays cash dividends at a certain rate. So, but the cash flow, basically the money that we pay out in dividends to stockholders, basically always affects the stock's market value because they feel like you have a strong position, you're comfortable, things are going well, and we're getting a return on our investment. What does that mean? Am I getting a return on my investment if I don't get a dividend? Sure, I'm getting a return as long as the market price of the stock increases. But when I'm getting a dividend, it's almost like it's a definite return, right? I'm actually getting money out of it. About 75% of common stock incorporations pay out dividends. All right. Whoops, I kind of went a little bit too fast. Notice something down here. In order to pay a cash dividend, you've got to have two things. One of them, maybe you didn't know, but the other one is kind of like duh. First, you have to have a sufficient balance in retained earnings because that's where dividends come from. You've got to have enough money in your retained earnings. That is a credit balance in order to pay the dividends out. This is the duh one. If you're going to pay a cash dividend, you better have enough cash necessary to pay it. Yeah, I think we'll probably all get that. So when we're accounting for cash dividends, there's 3 dates that we need to think about. First is the date of declaration, and that's when the board of directors kind of makes that shout out, we're going to have a dividend, we're going to pay a dividend out. As soon as the board says that, as soon as they declare that there's going to be a dividend, the company has a liability. Well, you know already that if there's a liability, you have to record it. You must record a liability. So on the date of declaration, we go ahead and record that liability. The date of record is the date in which the board of directors says if people own stock on this particular date, those are the people that are going to get the dividend. So usually the date of record is later than that date of declaration. So if the date of declaration is June 15th, what they're basically saying is we are going to declare a dividend of X number of dollars per share of stock for all stockholders who own shares as of February 15th, right? So everybody who owns the stock on February 15th gets the dividend. What do you think happens between January and February once that happens? A lot of people are going to go out and probably try to buy the stock because they want to get in on that dividend. And then the date of payment is when we simply relieve this liability and pay the dividend out in cash. Let's look at an example. January 9th, $1 per share cash dividend declared on Z-Tech Inc.'s 5,000 common shares. So how much is the dividend? 5,000 shares, $1 per share. We're going to spend $5,000. The dividend is going to be paid on February 1st to stockholders of record on January 22nd. So what do I have to record on January 9th? This was the date that the board declared the dividend. I've incurred a liability. Where do dividends come from? Dividends are a distribution of net income in the company to its stockholders. Where do we put net income year over year over year? You've got to think back, right? Every year we record revenue and expenses on the income statement. By the way, if you're struggling with that concept at this point in the game, you really need to go back and review what's on each financial statement. It's a very, very, very important piece of this. The income statement has revenues minus expenses, and if revenues are bigger, it equals net income. Net income is the reason that we are in business. It's also called profit. It's the reason we're in business. We're in business to make money. And the indicator of that is revenue minus expenses, which equals net income. Every year, we've got to take that net income, right? Those revenue accounts and those expense accounts. At the end of every year, we have to zero those accounts out to start a new year, right? On January 1, my revenue and expense accounts have to all be empty so that I can record a new year coming forward. Well, how did I ever get it out of there? How did I get the money out of the revenue account? How did I get the money out of the expense accounts? I made a closing entry, closing all revenue accounts and all expense accounts into income summary, and then I closed income summary where? Into retained earnings, right? So every year, all net income gets accumulated into retained earnings. So retained earnings is simply an accumulation of net income and net losses year over year over year. So it becomes the bucket holder of all the profits of the organization. What are dividends? Dividends are a distribution of profit to the stockholders. So it makes sense that when we declare a dividend, we take it out of accumulated profits, which is called retained earnings. So I debit retained earnings because it normally has a credit balance. I debit retained earnings for $5,000 and I owe it. So I'm going to call it a common dividend payable of $5,000. That's the date of declaration. What happens on January 22nd? Nothing. You don't have to record anything. The board of directors simply said that we're going to pay a dividend to everybody who owns stock as of January 22nd. That's it. So on February 1st, very simply, I take the liability off the books with a debit and I pay the cash out with a credit. All right, what about deficits? Can't have it. You can't pay a cash dividend if you have a deficit in retained earnings. It was one of the rules I showed you back there. In this case, there's a retained earnings deficit of $6,000. I cannot declare a cash dividend in this. How do I end up with a retained earnings deficit? Well, because we've either incurred a cumulative loss, right? That means I didn't have net income year over year. I ended up having losses year over year, or at least I had at least one big enough loss to take away my net income. Or I paid dividends greater than total profits earned in other years, which is a no-no. You're not supposed to do that. You're supposed to have sufficient retained earnings to do it. So how can a company get past this if they can't pay out a cash dividend? Well, they can also do what they call issuing. They don't pay it, but they can issue a stock dividend. And this is a distribution of a corporation's own shares to its stockholders without receiving any kind of payment in return. So we, the organization, the company, the corporation, we're not going to get anything in return for this, but we are going to issue more stock out to our stockholders. Why would we do that? Well, it says it can be used to keep the market price on the stock affordable. Okay, because you're putting more stock out there, right? I guess it's kind of diluting the market price. And it says it can provide evidence of management's confidence that management believes it's doing well. I kind of have a little bit of a problem with that one because I always feel like if you're giving me a stock dividend instead of a cash dividend, it's probably because you don't have enough money to do it. So I kind of argue that point a little bit with the publisher. I don't know that I necessarily agree with it. It certainly can be evidence that they're doing well and maybe they want to keep the money in-house because we're going to invest in new things. Fine, I get that. Tell me that. Make sure that you understand that if you get a stock dividend, that they're not cash poor, right? Because cash poor has a whole nother bad set of meanings, right? So when we do a stock dividend, it's going to be considered one of two ways. It's either going to be called a small stock dividend, which means the distribution is less than or equal to 25% of the previous outstanding shares, or it's going to be a large stock dividend, which it means the distribution is going to be greater than 25%. Not difficult to deal with. It's just two different accounting methods. Here's the first example, looking at a small stock dividend. Quest has 10,000 shares. Imagine we're Quest. We have 10,000 shares of $10 par value stock outstanding, and on December 31, our board of directors declared a 10% stock dividend when the stock was selling at $15 per share. A 10% stock dividend is obviously less than 25%. That's pretty simple math. Well, what does that mean? It means that 10% of our outstanding shares, we're going to actually send more shares out there. What's 10% of 10,000 shares? It's another 1,000 shares. So we're actually going to distribute another 1,000 shares of stock, which means we're no longer going to have 10,000 shares outstanding. We're going to have 11,000 shares outstanding. Hope you get that, right? Because it can get a little bit confusing. Why do we care about the fact that it was selling for 15 per share? Because in a small stock dividend, we account for that 1,000 share distribution at the market price, right? So let's look at this. Well, if I take 1,000 shares at $15 per share, the dividend, right, the amount that I'm reducing retained earnings by is going to be $15,000. but now I have to issue the stock. Well, I can't issue stock at anything greater than par value. So 1,000 shares at $10 par is 10,000 on the common stock account, with the difference of 5,000 going into paid-in capital. Nothing's really changed here. This looks more like a stock issuance than it does a dividend, right? Except instead of getting cash for the issuance, I'm reducing the retained earnings account because it went out as a dividend. That's the only difference. How about a large stock dividend? Oh, I guess, yeah, notice this. Before the stock dividends, total stockholders' equity was 143,000, and it's going to remain 143,000 because I reduced this number and increased these numbers. Okay, that just shows the same thing. So what about a large stock dividend? Same example, kind of. 10,000 shares, dollar par value stock outstanding December 31. Quest declared a 30% stock dividend. Okay, 30% is obviously bigger than 25%. What does it mean? It means we're going to issue 30% of 10,000 shares, right? 30% of 10,000 shares. How do we account for that? Well, that means if we're going to issue out 3,000 shares, and they have a little bit of a problem here because this is supposed to say 10. I just realized that's a problem. $10 par value, this should not be a dollar par value, this should be 10. But that's going to equal, if it's a $10 par value, it's $30,000. What happens different here is that in a large stock dividend, we don't worry about the market price. We ignore the market price completely, and we're going to book the dividend of $30,000. That's going to be the 10,000 shares, the 3,000 shares at $10 par value, and then push it out to common stock dividend distributable, and then we get the shares out of there. A little confusing on that par value. I got to get that one corrected. All right, the stock splits. What's a stock split? Most people have heard this and they know it means that we get more stock, but maybe they don't really understand what it does, right? So it's a distribution of additional shares of stock to stockholders according to their percent ownership. It has nothing to do with the dividend. It does not reduce retained earnings. All it does is it splits everything in half, kind of, sort of, right? So if I think about what my old shares were before a stock split, if I had 100,000 shares out there at $20 par value, and if I do a 2-for-1 split, what happens is I'm issuing basically another 100,000 shares. That's the 2 part, right? But I reduce the par value to 10. Well, that's the same, right? 100,000 times $20 par value is exactly the same as 200,000 shares times a $10 par value. Why would I do this? Well, my stockholders would love the opportunity to have double the shares, because now those shares can go up in market price at a bigger level or even at a faster level. What does it also do? It puts a whole bunch of shares out there on the market at now a reduced price and reduced par value, which will attract new investors. All right, so what is preferred stock? Preferred stock is a different classification of stock. It usually has priority over common shares, in the fact that people who have preferred stock are going to get rights to dividend distributions first, and they're going to get a distribution of assets in liquidation before common stockholders. The downfall is that they normally have no voting rights. They have no voting rights at all. They can't elect anybody. Preferred stock usually has a stated dividend rate. So when people buy preferred stock, it's going to be because they kind of have a guaranteed dividend if one is declared before common stockholders get it. About 73% of corporations have no preferred stock, only 27%. Usually we see preferred stock in the banking industry and publicly traded banks. Preferred stock can also be considered either cumulative or non-cumulative. Cumulative means that dividends and arrears have to be paid before dividends can be paid to common. People love cumulative stock. What does that mean? It means that if you own preferred stock and you didn't get your dividend in prior years because they didn't declare it, and now all of a sudden in the current year they declare a dividend, they have to pay you for all those past years plus the current year before any of it can go to common stockholders. That's what cumulative means. That's what you want, right? Yeah, well, that stock usually costs more too. Non-cumulative means that you only have a right to get the current year. They don't have to pay you for the prior years. Let's look at this one. Following stockholders' equity section, the balance sheet, board of directors declares $5,000 of dividends in 14. In 2015, the board declared and paid dividends of $42,000. Well, what did preferred stockholders have? There's 1,000 shares out there, right, that are guaranteed a 9% dividend. That's what this means. Well, that means they're guaranteed a $9,000 per year dividend. And in 2014, they did $5,000. In 2015, they did $42,000. Who got all of this dividend in 2014? The preferred stockholders, right? Common didn't get any. And then in 2015, everybody's going to get some, but depending on whether it was cumulative or non-cumulative can change the picture. Let's take a look at that. Here's what it looks like if it's non-cumulative. In 2014, the preferred stockholders got it all, but in 2015, we've just got to pay the preferred stockholders their $9,000 first, and the remainder, remember it was $42,000, the remainder then gets to go to common stockholders, and we're done. But if it had been cumulative stock, in 2014, the $5,000 goes to the preferred stockholders, but then they've got to repay those preferred stockholders for what they didn't get in 14. So they've got to give them the $4,000. Why? Because they only got $5,000 in 14 when they should have gotten $9,000. So I've got to pay them up the $4,000. Then I've got to give them the $9,000 from this year. And then in order to complete the $42,000 transaction, the remainder goes to common stock. Obviously, we would like cumulative preferred stock if we're going to buy it, but again, you're going to pay more money for that. Preferred stock can also be participating or non-participating. We do not see participating much. Non-participating has a feature that limits the dividends to a maximum amount each year. That maximum usually is stated as a percent of the stock's par value or as the specific dollar amount per share. And once those preferred stockholders receive that, the common stockholders get the rest, period. Right? And that's kind of in that previous example. But in participating preferred stock, the one over there on the left, what happens there is that once they get their amount, then the board of directors can actually declare that more can go to the preferred stock. We just don't see that. But we can only exceed that stated amount after the common stockholders get theirs equal to what preferred got. So it's a little bit complicated. Again, in my entire career, I've never seen participating preferred stock. So why would we issue preferred stock? Well, to raise capital without sacrificing control. Why wouldn't they sacrifice control? Remember, preferred stock has no voting rights. To boost the return earned by common stockholders through financial leverage. Well, what does that mean? It's because it's more like borrowing money, and we don't affect the equity. Earnings per share really doesn't change. And to appeal to investors who might believe common stock is too risky, preferred stock has preferential treatment. That's why they call it preferred. They get to get their money back out in a liquidation before common stockholders do, so it is less risky. So let's talk about treasury stock. And treasury stock is just one of those weird things. Sometimes a corporation will acquire shares of their own stock for a few different reasons. One, they might use their shares to acquire another corporation. They might try to avoid a hostile takeover, meaning I want to go and get my stock off of the open market so no one else can buy it and try to run me out, right? Because if they buy more than my percentage, then they have the control. Maybe we want to reissue stock to employees as compensation. We want to reward our employees, but again, we don't want to affect that control. We don't want to dilute our shares, or because maybe we want to maintain a strong market for the stock or show management confidence in the current price. That's what would happen with treasury stock. So a corporation's required shares are called treasury stock, which is similar to unissued stock in a lot of different ways. One, treasury stock is not an asset. Remember, when we pull back in treasury stock, it cannot be counted as an asset investment because you cannot invest in yourself. Treasury stock doesn't receive cash dividends or any kind of stock dividends. So we have to think about that as we go through. If we've got treasury stock on the books, we can't issue dividends to those stock shares. Treasury stock doesn't allow the exercise of voting rights either. right? But treasury stock does differ from unissued stock in one primary way, and that is that the corporation can resell treasury stock at less than par without having the buyer incur a liability. That's if it was originally issued at par value or higher. These treasury stock purchases also require management to exercise some sensitivity because funds are being paid to specific stockholders instead of all stockholders. So you don't want to be caught in the crosshairs with some ethical stuff. This graph indicates that the majority of corporations have some treasury stock. All right, so let's just kind of walk through how we purchase treasury stock. Example, May 1, Cyber Inc. purchased 1,000 of its own shares in the open market for $11.50 per share. Okay, so this is the problem that we have in accounting with treasury stock, is that we've got to track every batch of treasury stock that we purchased based on what we paid for it. That now becomes what we call our basis in it. Remember, treasury stock is not an asset. It's not an investment in another company. Basically, all we're doing is we're reducing the amount of our equity that sits out there on the open market. So it really becomes a reduction or a negative in stockholders' equity on the balance sheet. $11.50 per share, 1,000 shares, you see what happens. Now we've got treasury stock common, but it sits as a debit. That's the negative in the equity section of $11,500, and we paid cash for it, $11,500. What if we sell it? In this case, on May 21, we sold 100 shares of the stock back for $11.50 per share. Well, good, because that's exactly what we paid for it. So I haven't made any money, haven't lost any money. Everything is okay. So 100 of those shares are going back out. What did I get? I got cash. Take the treasury stock off the books. But now what if I sell it at $12 a share? Well, yay me. You know, I mean, that's a great thing. How do I book it? Well, I got $12, 400 shares, $4,800 cash coming in the door, but I still have to take the treasury stock off the books at what I originally paid for it. That was $11.50 per share, or $4,600. Because I got more than what I actually had it on my books, I have what kind of feels like a gain, but remember, I'm not in this to try to make money or lose money. That's not why we do treasury stock. So it's more like paid in capital. Somebody paid me more for their stock than what I had it at a stated value as. That's called paid in capital, and we're going to track that as treasury stock. I'm going to just say this, though. This account kind of becomes a plug account. So if I end up selling treasury stock at a really low rate, and I end up kind of quote-unquote losing money on it, I've got to take it from here first. It has to come out of this first, but what if I don't have enough? Because I can't make this account go below zero, and I'm sure we're going to see that in a sec. Right here, July 10, Cyber now sold an additional 500 shares of its treasury stock for $10 per share. Well, that's bad because I paid $11.50 for my own stock, and now I can only sell it for $10. Whoops, I made a mistake. First thing, what do I know? I know I'm getting $5,000 in cash. That's easy to book. I know I've got to take the treasury stock off at $11.50. That's easy to book. But now what do I do about the difference? Remember what I said? If you sell it at a quote-unquote loss, you take it out of that paid-in capital account first. But if it's not enough, what do we do? In this case, I need $750 to make it balance out. $200 came away. What do I do with this debit of $550? Looks like they forgot to type the rest of it out. The $550 has to come from retained earnings. I basically just have to eat it. All right, what's the statement of retained earnings? It's one of those great financial statements, without a doubt, right? We've already learned about that. Income statement, statement of retained earnings, balance sheet, and cash flows, right? The retained earnings, remember, is the total cumulative amount of reported net income year over year over year over year, ever since the company started, right? So it really is the accumulation of profit year over year. But you have to understand that some companies might have their retained earnings restricted. They can be restricted for legal reasons. It could be by state charter saying that the amount of treasury stock can never exceed the amount of retained earnings. And there might be a contractual restriction, like a loan arrangement. Maybe the bank says, I don't want you to let your retained earnings fall below a certain level by issuing dividends because we want to make sure that you can pay us back. What about prior period adjustments? Prior period adjustments are changes to retained earnings. What's a prior period adjustment? Well, let's say that we're now in December 31, 2015. You see this here, but we've realized that back in 2014 we screwed up. We actually expensed land instead of putting it on the balance sheet. And when we expensed it, we got an income tax benefit. So really, we have a net problem here of $147,000, right? Well, we're not going to go back and restate all of 2014's financials because of our screw up, especially if that screw up was immaterial to a reader's decision. I guess that's what they're thinking here. So what do? We take our original December 31, 2014 retained earnings, adjust it for the prior period adjustment, list out why, you got to tell us why, to get us a new adjusted balance, and then the rest goes from there. We add in the net income, take away the dividend declarations, and get our new retained earnings balance. This is just a more inclusive statement than the regular statement of retained earnings. Sometimes you will report stockholders' equity that includes changes in retained earnings over time. This one lists the beginning and ending balances of key equity accounts. We hardly ever see this one. All right, what about stock options? Well, that's when we give someone the right to purchase common stock at a fixed price over time. This is usually a part of an employment contract. Maybe you've heard of this before. If you work for us so long, we'll allow you to purchase our own company stock at a certain share. In this case, they're saying that employees can purchase at $30 a share, even though the market price is $75 per share. The reason we give this to employees is that we're trying to motivate them to focus on company performance, because the bigger it gets, the more money they're going to make off of this. To take a long run perspective, to look farther out into the future, to think about what it does for their retirement, and to keep them with the company. That's going to conclude Chapter 11.